All right, good morning, everybody. So yesterday, everybody kept saying the CPI was the biggest event for the week. And yet this morning we have hedging. So yesterday wasn't the biggest event because yesterday we didn't have a hedging, but today we do. I would say that the market's more concerned about PPI than it was CPI. But we've also got other data today, and that could have a maybe an influence on whether or not this hedging is from PPI or the other event. We will know if we get through the PPI and the hedging is still there and continues to increase, or if it starts to decrease afterwards. And I'll show you where I see that so that you can be able to spot it on your own and recognize that there is hedging going on. This isn't my opinion. I'm not assuming that they are hedging. It's a fact. It is worth noting that the institutions always hedge, right? They're always hedged. So it's not like they weren't and then now they are. This is extra insurance. This is extra protection, and it is a cost. I know a lot of retail traders, we like to use hedging activity as a way to actually just make a trade. But for them and with their size, it's always an expense. So it's like taking your money and just throwing it in the fire. But that's insurance, right? You buy homeowners insurance, car insurance, so that if the worst happens, you get some sort of protection, but it'll never make you whole again, no matter how much money you spend on insurance. Markets are basically flat, waiting on this. We can see nothing is up or down more than a 0.5%. And really, between the Russell and the NASDAQ, if it wasn't for those two, we really could say nothing's up or down more than 0.25%. Everything's tight range, waiting on this data. Again, implying that yesterday wasn't the big issue. Today is. And when we stayed in that really tight range yesterday, I started to consider that perhaps we were all focused on the wrong thing, not CPI, PPI. So either way, we're here. There was a lot of tells from yesterday implying that this is the day of concern. After PPI, we've got some Fed speakers chipping teeth, and we've got some UMich consumer sentiment. It is a sentiment gauge. You know, this is that warm, fuzzy feeling or lack of. So it's to be taken with a bit of salt behind it, perhaps, but still, it is one considered high impact, high risk. So you always want to know when that one is coming in. And it seems like every day somebody asks me, hey, what's on the table for tomorrow? What are we focused on this week? Every day I go through these websites, and every one of these you can go to for free. It doesn't cost you anything. I've wrote about them in my blogs. I've put links out there. You don't have to wait on me to do the morning briefing to see these. And I do these morning briefings to teach you how to do it, right? I'm really not trying to give you my take on the day. I'm trying to show you how to do these steps so that you don't need me at all. So rather than asking me, hey, what's on the table tomorrow? What's the economic events this week? Try going to some of these websites and looking around so that you're able to answer that question on your own. If you need the link to the blog post where I shared all of these links, just let me know. I'll send it in your direction. Otherwise, they're all free. It doesn't cost you anything, right? These Fed speakers, it's always a threat that they can be taken out of context, say something that they didn't mean to say. They can move the markets in a way that they weren't intending to move them. So of course we want to pay attention when there's Fed speakers out there chipping their teeth. It's very likely that they're all going to just continue to pound on the same drum that they beat inflation, yay, and now it's all about employment. But there's more and more analysts that are popping up saying that they're not done with inflation, but they've now started juggling both employment and inflation as their number one issue of the moment. They got two number ones, so to speak, and well, I mean, they don't do a very good job when they focus on only one task at a time. We'll see how well they do when they focus on more than one at a time. We also, because of these events, have the opportunity for a liquidity gap play. It's the same play that we were talking about yesterday. And every time we have a CPI, PPI, non-farm payrolls, 830 candle, it's the idea that we can get a very large print candle. I like to use a 5-minute chart for these, just so that it's got a consistency between where it opened, where it closed, and how much wick we have on either side. If you want to hear that rant, you could just watch the beginning of yesterday's morning briefing. I think it's done in 10 minutes or less. Or go back to any of the other morning briefings that I've done that was on a CPI, PPI, non-farm payrolls day, because I do it just about every time. You see the amount of volume that came in yesterday after we got that large candle, right? And that large candle that we got yesterday for CPI, this was not a liquidity gap play that I would want to trade because of the big wicks on each end. Now, it was a liquidity gap, just not one as a setup that I would want. And we did get back there and we did get it closed eventually. That's a 15-minute. Want to look at it on a little different time frame. Right there, 58.36. And we got there a little after 11, probably closer to 12. But we did get it closed. This is not the kind of gap play that I want, right? I want a nice, clean gap. No wicks really on either end. We can see that they're hedging this morning. One, because I'm using this indicator that shows me what the market maker move is. But even if you're on a platform that's not Thinkorswim and you don't have it, if you go into the options chain on the ES futures, we can see that the front end implied volatility average is higher than the next expiration. When the front end is higher than the next one, this is what is called a market maker move. Thinkorswim puts the label up here at the top. So you can do this in equities. It's often used on earnings for equities. You know, like say Apple was going to have earnings, there would be a market maker move. The front end would be all jacked up and would be higher than the next expiration out. If you go to the Schwab website and you search for market maker move, they've taken all the articles that were written over the years when TD Ameritrade owned Thinkorswim, and they condensed them into one article talking about the market maker move. It'll explain it, but they don't mention futures at all. I just kind of got there over the years because I use Thinkorswim every day and I focus on the futures. So it just kind of led me here. But this is hedging in the front end, right? This isn't my opinion. I'm not assuming. I don't have to. We can see it. So these outsized positions this morning, that high volume on each side, that is the hedging, right? That activity increases the implied volatility average and makes the front average greater than the next average out, and then we get a market maker move. If they weren't worried about this morning, they wouldn't hedge it, right? That makes sense. Why spend the money if there's no fear? So while we all get concerned when we have these events and we think, oh yeah, it's going to be a big move. I mean, it still could, but big moves are generally caused by surprise, right? We get hit with something that we weren't expecting and they're off sides and not covered. And then everybody is scrambling to do something all at once. They're all trying to buy, they're all trying to sell. But if they're hedged, they don't care which way it goes. There's no surprise here, right? If it goes down, they're okay. If it goes up, they're okay. Why would we get a big move? Not to say that we won't get the initial 5-minute big bar. I'm talking more about the big move that sticks and we just continue to move in a single direction, like one-time framing, and we just keep driving it farther and farther and farther. Why would we get that on a day where they're hedged? We likely won't. I did share a picture a little bit ago about the range on the day. You know, if we put lipstick on a pig, so to speak, we've got our range from yesterday already laid out. Yesterday's high, yesterday's low, which is also a cog line. Then we got the roundy down at 58.03. It's also the ADR half. Looking at yesterday's high, right above it, we've got the call wall. Then we've got the options level, 58.50. So we can get out of this range, but we're going to need a heck of a push to get us out of this range. So I've got the new ATR indicator made. I'll end up sharing that out over the next few days. I'll put it in the Thinkorswim workbook. It does have a label suggesting where the upper and lower ATR half is. I didn't do a label for the full. It just seemed redundant. And you can see that it's a little wider than my ADR levels. It's not a big deal. It's wider because it's running an average called Wilder's instead of using a simple average like my ADRs. But it's the same thing at the end. The labels will be the same. So you'll have all the pieces. And these bubbles will, of course, be something that you can turn on, turn off, change the location of where the bubbles are, all that good stuff. The range is pretty narrow. As a part of the discussion we had the other day about how wide or how narrow things are. At the first week of August, we were running an ADR that was about 100 points. Now it's 55 points. It's almost half of what it was. So we need a way to kind of gauge whether or not we're in a high ATR environment or not. And I've built an ADR rank indicator, much like an IV rank, right? That way, one, you can compare it to other markets, but two, you get a pretty good idea of the size of the ATR right now or the ADR on whether or not we're in a high volatility environment or a high ATR condition or not. So if we think of rank, we're in the 23rd percentile right now. ATR is pretty low, all things considered. We were much higher back in August, like I mentioned. It was a lot wider, or even back in April. Now, what we do with this market maker move is we add it to what the market could do today on its range. If 5,900 is the ADR high, or the ATR high, then we would add another 13 points on top of that. It'd be 59.13 if we just went from the round number. And same thing from the bottom. We would subtract another 13 points off of the bottom. So it's just adding a little bit more to the range. And just as another picture of volatility, we've got a daily one standard deviation right now of, let's just round it and say 74 points. So that's really small compared to this, right? Because we would cut this number in half. Or if you wanted to make these equal, double this. So we're moving about 110 points, and we're only supposed to be moving about 73 points. So we are in a violent environment, and we are still exceeding the range that we should be making on a day-to-day basis. Don't let yesterday fool you. Yesterday was just a waiting on data day. We're still holding above the weekly floor pivot, and today's channel is significantly skinnier than yesterday's channel. The width of these channels helps us try to imply what today's price should do. In a wide channel environment, we expect breakouts to fail and that we will form and build and trade within a range. A really narrow channel implies that if we test the edges of the range and break out, that the breakout could stick, we could grow legs and really expand. Now, these channels don't make us break out. They don't hold us in place. They don't influence price. They're influencing our perspective on price. Spot Gamma's Gamma Index does the same thing. If it's -2, -3, we believe that should we break out, the breakout will grow legs and will really run. Same concept, just different tools. Whereas if the Spot Gamma's index is, like a +2, +3, then we expect breakouts to fail and that we come back in the range and we hold the range. Same idea. This isn't as narrow as it could be, but it's definitely more narrow than yesterday. The fact that it is above yesterday's pivot is bullish, but it is still within the channel, and price opened above, and that is considered bullish, but we weren't able to keep it. Now we're underneath our own floor pivot. When we consider narrow ranges on something like the ATR, one of the easiest ways to kind of visualize that for other people is to turn on the SNR levels on floor pivots. When we do that, you can see how some of these red and green lines are really far apart. Take like this day here on September 9th. The R3 and S3 lines, that's how far apart they were. It was a high volatility, high event kind of trading day. You take that same range and bring it over into what we have today. There's your R3 and your S3 in this very tiny, very narrow range, and compare that with the box that I just drew. All right, so if you're using some tool or some trading strategy that says, oh yeah, when we get to R2, go short, or we get to S2, go long. Because we've traveled a long way and we're going to mean revert. Yeah, okay, maybe. But this is a very narrow range. We can get to R2, R3, S3. We can get there very easy because, well, the lines are really close together. So proceed with caution if you're using that kind of trading strategy or that kind of trade logic, because these levels are not very far apart at the moment. All right, so we're looking at the week's volume profile, kind of comparing it with last week. We can see all this volume across the top, and this isn't exactly your classic P-shape profile because of this high volume area here. That kind of breaks it all up, and it doesn't give us that classic look. But the conditions of our profile right now really match that P-shape profile, that we've got this large D area, and the point of control is in the upper part of the profile. This needs to stick, right? Right now we're in the zone, so we can hover back and forth around this thing. It won't be supportive. It won't be resistance. It'll be a bit like a magnet, and we can just hold here and chop back and forth, no problem. The issue is once we leave the range. So once we leave the range to the upside, if we come back down, we'll look to see if it's supportive. If we leave the range to the downside and we come back up, we'll look to see if it's resistive. Until then, as long as we're just chopping here back and forth, then it's just a magnet. But it's helping us form what we call a draw and raid. So the draw is drawing everybody in. As long as price stays in this zone, nobody knows if they're wrong yet. Longs can get in here thinking this is the precursor to the start of a whole new leg up. Bears can get in here thinking this is a topping pattern. We're finally done. We're going to roll over and go back down. Both sides can get in, and both sides wouldn't know if they're wrong yet until we leave the range. So it's a draw. It'll draw everybody in. Swing trade logic concepts suggest that if you're short in a zone or a range like this, that you would be putting your stops up here. And that if you're long in a range like this to go higher, you're going to be putting your stops down here. That's where the raid comes in. So draw everybody in, raid the liquidity in the opposite direction of the move you're about to take, and then make the move. So if we're to go down, we'd expect one more push to the upside, break the previous high, collect that liquidity, and then head to the bottom. Or if we're going long, one more dip down, get into the liquidity, and then make the move to the upside. We don't have the move yet, but we can see examples of this back here. This isn't a great example, but it kind of gets the idea across. There's your draw, there's your raid, there's your run. It's not a very great example, but it'll do. So we need to finish this off, right? We need to get out of this range. GTFO is what I put in today's must have. We got to break this draw and go. Just try not to be fooled by the first move that we get. That may be the raid. 5781 is above last week's point of control, so a little bit of a speed bump. If we do break 5811, get through the roundy, then we've got 81 before we have last week's point of control around 5760 area. After that, We've got the low of last week, 57.22, and then things start to get really ugly. Below 57.22, we got the 11 cog line, and then 5700 roundy, 56.92 cog line, and then it's a really deep drop after that. It's what they call an air pocket of risk. Ten-day, 30-minute volume profile. The point of control has still not shifted yet, but the expectation is that it will today. Now, if we drop back down into that, then we can prolong its time at this location. But I think the clock is ticking and we're running out of time here. It's very likely going to shift today if we don't break yesterday's low and go down into it. No VPOC since yesterday was so tight. The one that we would have drawn, we've already run through it. Any move to the upside this morning, and we're going to hit our head on this volume up here. It's where the TPO has the greatest amount of trading activity, 58.32 cog line. So we had the greatest amount of trades there, but we had the greatest amount of volume down here, implying that we dropped down into an iceberg and they were waiting down here. They took a front run on it, by the way, stepped in to protect it before it even broke out of yesterday's range. We're still above the 10-day, less than 0.5%. A little bit of a drawback is fine. As long as we're still holding above the 10, everything is okay. We haven't gotten too far ahead of our skis. We're not overbought. We're not overextended. We haven't moved too far, too fast. It doesn't owe us anything. We're 2.6% above the 10-week. That may feel like a lot, but if you look at where we're at right now, and I hold my mouse there, you can see that a lot of bars are higher than the line that my mouse is creating. So we've been, at 3.0, 4.0, we've really been extended above that 10-week, much greater than we are right now. This is a good spot to be, 2.5, 2.0, even 3% above the 10-week. There's nothing wrong with that. It's just a good, strong, healthy place to be. Because it's Friday, we've got next week's range on the table. It's not set in stone yet. All of these previous weeks, once Friday ends, these lines get locked into place, and that's where they stay. Today's lines that we're seeing for next week, these are still moving. They're still shifting. This gray line is our current price. And so as price moves up and down today, this gray line is going to move up and down today, and these red and green lines are going to move up and down today. After the close, at around 4:15 or so, this indicator will lock into place. The lines won't move, and then we'll have next week's range. What we can do is get a little bit of a preview on how things look for next week. We can measure this week's range and compare it with next week's range and see if it's larger or smaller. And as you can see, next week's range is bigger than this week's range. Now that can change by the end of the day, but at the moment, it implies that the market is really concerned about something going on next week. These ranges are based on time and volatility. Well, there's not more than 5 days, so we know that there's not more time in next week's range than there is in this week's range. The only other thing that could be more is volatility. they're jacking up the volatility into next week because they're concerned about something. Remember that change in volatility, which is based on these levels, is based on the activity of the trading that's happening out of the money. That's how these averages are calculated, is based on the out of the money options being traded. So the more they trade hedging that out, whatever they're worried about, the more they're going to expand that volatility. So you really want to look at what's on the agenda over the next week, right? I know on Spot Gamma, one thing they continue to focus on is the election that's coming up as a source of one of the big volatility tells. And they write about it a lot in their morning briefing or their founder's note. But we've also got OPEX next week. That's every month on the third Friday of the month, we have options expiration. I just looked. They came out with the AM edition early. I really thought they would wait for PPI, but they didn't. In their notes, they were saying that it didn't really look like they were worried about, that the market was worried about PPI, because they weren't seeing any of the vols get jacked up, right? The volatility just wasn't there to imply that there was any sort of a threat. But I'm telling you, they're hedging. So it might not have been in the cards, before today, but they are definitely hedging this morning. There's really no need to dig into the things that are up this morning or the things that are down this morning. We need to get this data first, right? We've seen that around the world, we're mostly sideways at less than 0.25% positive and negative waiting on this data. Everything is waiting on this data unless it had some news. See, the China group is down again, 2.4%. They're hyping up this Saturday meeting a little bit more, trying to show their hand a little bit without giving anything away, and investors aren't buying it. So we'll see if they come out with something really good Saturday. You may see those China internet ETFs and the China ADR group make a reasonably decent move next week. But if they keep hyping this up and then they don't give something good, the markets are going to punish it brutally and just rug pull, I think. So we'll see. I don't know what they're going to come out with, right? You can't really anticipate that. It's like trying to guess what's going to happen for earnings. Who knows? The Mag 7 group is down this morning. Consumer discretionary down. So those aren't good. If we was looking for a rally day, those were the names that we would want to see to the upside. Financials are up, which, I mean, we're starting earnings on some banks this morning. KRE, XLF, Bitcoin is up 2.5%. And, sneaky in the background, we've been seeing more and more Bitcoin proxies just kind of easing to the upside. It looks like we're finally starting to get that break. And if we're going to get this sustained run into the end of the year, right? It's not a Santa Claus rally if it starts before Thanksgiving. But if we're going to get that run into the end of the year, definitely need the Bitcoin group, because it's a sign of risk appetite and liquidity. So kind of got to have it. And then the gold miners are up this morning. Nice to see precious metals turning around. but everything else is on wait. Semiconductors not doing anything. Jets, airlines, cloud computing. You know, after the moves in software and services yesterday, you'd expect that we'd have seen that pull back, and nope. So pirate phrase, you know, keep what you take, don't give anything back. So they're keeping it. That's what I got, guys. Watch the clock. Be careful, be safe, enjoy your weekend. I'll see y'all Monday.